Have you ever wondered how rising delinquencies in commercial real estate might actually create golden opportunities for investors and brokers? Welcome to the Commercial Real Estate Insights Podcast. I'm your host, Steve Hamoen. Let's get right to it. As delinquencies continue to rise in the commercial real estate sector, many mortgage holders may find themselves in a bind, potentially forced to sell their properties. According to Robert Martinek, director at Eisner Amper, this situation could present significant opportunities for mortgage brokers and investors to secure properties at substantial discounts. Martinek shared with Mortgage Professional America that once extensions and deferrals are no longer options for delinquent properties, the market might see significant bargains for those ready to invest. Martinek highlighted a striking example from Minneapolis, where a building originally purchased for $95 million sold for a mere $15 million. Such examples underscore the potential for investors to capitalize on market distress. Struggling markets, particularly in California and Texas, could provide even more opportunities for investors and prospective tenants. The West Coast and cities like Dallas and Houston are currently experiencing high vacancy rates, prompting building owners to offer attractive incentives like extended free rent periods and increased tenant improvement allowances to lure tenants. In the face of elevated interest rates, many potential sellers are hesitant to let go of their low-rate mortgages, contributing to a scarcity of available properties. Martinek suggests that if interest rates decrease, the market might see an increase in supply, potentially leading to more transactions. While Class A office spaces remain in demand, Class B and C spaces continue to struggle, with some cities performing poorly in the office space sector. However, New York City is one example where developers are successfully converting distressed commercial properties into residential spaces, including affordable housing, which has contributed to a market turnaround. Martinek also pointed out that the lending space is seeing considerable competition, leading to some questionable practices in the past. However, he believes that the majority of loans being closed now are sound, with good deals being the focus. As the market evolves, everyone is chasing the solid deals, like industrial portfolios or data centers, which are seen as more secure investments. In a significant development in the Phoenix commercial real estate market, Denver-based Coble & Company has made its first acquisition in the area with the purchase of the Camelback Collective office building. This transaction is notable as it marks the largest office sale in the Valley for the year 2025. The acquisition signals Coble & Company's strategic expansion into the Phoenix market, which is known for its dynamic growth and development opportunities. This move by Coble & Company reflects a broader trend of out-of-state investors looking to capitalize on the growing potential of the Phoenix area. The Camelback Collective, with its prime location and upgraded facilities, represents a valuable asset for the Denver-based firm as it seeks to establish a foothold in the bustling Phoenix office market. The sale of the Camelback Collective also highlights a shift in the office real estate sector, where properties in strategic locations are attracting substantial interest despite broader challenges in the commercial space. This trend is mirrored in other major U.S. cities, where investors are increasingly targeting office spaces that offer both strategic value and growth potential. For comparison, in the Kitchener-Waterloo area of Ontario, Canada, the office market is experiencing similar dynamics, with investors keen on properties that promise long-term value amid evolving work patterns. This cross-border relevance underscores the interconnected nature of the commercial real estate market, where strategic acquisitions can drive growth and offer significant returns. The University of New Mexico's South Campus is poised for substantial transformation with the announcement of a new retail development project. The university has sold 38 acres for the construction of the Lobo Crossing Shopping Center, a development that promises to significantly alter the landscape of the area. This project is being heralded as a major development for the region, bringing with it a host of new business opportunities and economic growth. The sale of this land marks a pivotal moment for the University of New Mexico, as it aims to leverage its real estate assets to foster a vibrant commercial hub that will not only serve the university community, but also the broader Albuquerque area. The Lobo Crossing Shopping Center is expected to attract a variety of retail tenants, offering a diverse shopping experience and contributing to the local economy. This development is indicative of a larger trend within the commercial real estate sector, where institutions and organizations are increasingly capitalizing on their real estate holdings to drive economic activity. The Lobo Crossing Shopping Center is set to become a cornerstone for retail in the area, potentially setting a precedent for similar developments in university towns across the United States. In Canada, the Kitchener-Waterloo region has seen similar initiatives, where educational institutions are partnering with developers to create mixed-use spaces that integrate retail, residential, and educational facilities. These projects have been successful in enhancing community engagement and providing additional revenue streams for the institutions involved. The cross-border relevance of such developments is clear, as both Canadian and American markets recognize the potential of transforming university campuses into bustling economic centers. This approach not only maximizes the utility of existing land, but also aligns with broader urban development goals, fostering sustainable growth and community integration. Edmonton's population growth has spurred a surge in investments in the commercial real estate sector, particularly in the multifamily home and retail categories. According to Jandip Diol, principal of multifamily with Avison Young Edmonton, the multifamily sector had been bleak for a while due to stagnant rental growth. However, the past few years have seen a turnaround, largely driven by the city's increasing population. An Avison Young report highlighted that population growth is a key factor favoring multifamily investments, with developers gearing up for new residential projects. The report also pointed out an imbalance in retail space supply and demand, leading to rising retail rental rates. Deal noted that as the population grows, rental markets prosper, and subsequently, the single-family for sale market benefits as well. In 2024, the Greater Edmonton area saw a total of $4.8 billion invested in commercial real estate, a 25% increase from the previous year. Multifamily assets attracted the most investment, with $1.89 billion, marking a 70% rise from 2023. The momentum continued into 2025, with the first quarter alone bringing in over $670 million for multifamily investments. Deal explained that the multifamily asset class covers a range from small 6-unit properties to new high-rise towers in downtown Edmonton. Currently, much of the development is happening in the suburbs, where new builds of 4 to 6 stories are adding significant numbers of units. The rise in multifamily investments is a response to increasing rental rates, which had remained relatively stagnant compared to other major Canadian cities. With more people moving to Alberta, many choose to rent initially, driving up demand in the rental market and attracting investment in the multifamily sector. DL mentioned that the market has experienced a pent-up rental growth necessary for years, leading to record-level transactions in cities like Edmonton and Calgary. Reid Newnham, principal of capital markets with Avison Young Edmonton, pointed out that the rise in rental growth is not limited to residential units. Retail rental rates have also increased due to rising demand and limited new developments. Newnham observed that with more dollars available for retail spending, existing retailers are expanding, leading to further increases in rental rates. Despite many retail spaces being available, changing consumer habits are prompting businesses to build new spaces that better meet consumer needs. Newnham noted that with the rise of online sales, retailers no longer require the same large footprints as before. This trend is even affecting restaurant spaces, which have reduced their average size due to fewer dine-in customers. In 2024, Edmonton's retail sector saw $411 million in investments, and the first quarter of 2025 has already surpassed $350 million, indicating a strong year ahead. With robust retail and multifamily investments, DO believes Edmonton's housing market could experience another surge as current renters transition to for-sale housing. DO expressed optimism about the continued business opportunities and embedded growth in Edmonton's market, suggesting that the city is poised for further development and expansion. Florida is making headlines with a significant policy shift that could impact the commercial real estate sector. Starting October 1st, the state will eliminate its 2% sales tax on business rent for commercial leases. This decision, signed into law by Governor Ron DeSantis through House Bill 7031, ends a long-standing tax that has been in place since 1969. The tax was gradually reduced from 6% to 2% since 2017, and its full elimination is seen as a victory for various business groups, including the Florida Chamber of Commerce and Florida Realtors. The elimination of the business rent tax is expected to enhance Florida's competitive edge when it comes to attracting new businesses and encouraging the growth of existing ones. Previously, Florida was the only state with a statewide sales tax on commercial leases, which many argued put it at a disadvantage despite its otherwise business-friendly tax environment. Gary Tasman, Chief Executive Officer and Principal Broker at Cushman & Wakefield Commercial Property, Southwest Florida, expressed that removing this tax will make Florida more competitive in recruiting and starting new businesses. Landlords have historically collected this tax along with rent, but the financial burden was ultimately felt by tenants. With the tax's removal, tenants will benefit from an effective decrease in their monthly rent. This is particularly beneficial for the office sector, which has faced challenges filling vacant spaces post-COVID-19 pandemic. Stan Stouter, founding partner of CRE Consultants, noted that even a small savings like this can make vacant office spaces more attractive to potential tenants. The new law also removes any sales surtax that some counties could impose on commercial leases. Mark Wilson, President and Chief Executive Officer of the Florida Chamber of Commerce, stated that this change is a significant win for Florida's competitiveness and will allow local businesses to reinvest savings into their employees, growth, and communities. Despite the tax's gradual reduction over the years, revenue from it continued to grow, reaching $2.64 billion in fiscal year 2024. This increase was attributed to a strong economy and growing population. A study commissioned by Florida Realtors suggested that eliminating the tax could spur $6 in economic activity for every dollar saved. This development could have ripple effects across the commercial real estate market, benefiting leases on various property types, including office and retail spaces. This policy shift in Florida highlights an ongoing trend in the commercial real estate sector, where tax strategies and incentives are increasingly influencing market dynamics and growth opportunities. As we observe these changes, it's crucial to consider their implications not only within Florida, but also in other regions where similar tax policies might be reconsidered to enhance competitiveness. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.